Hello and happy Monday, everybody. Hope you all had a great weekend. Here we are back at Market Mind. So thank you so much for being here today. Can you all see and hear me okay? I am not on the floor behind me. I will be back there in a couple days. I am not on the floor today. So hopefully sound is a little bit better. Guillermo, how you doing, man? It's another rough one for us Bears fans yesterday, that's for sure. It's just getting really, really old, really old. It's pretty bad. So market for the most part pretty quiet today. The Nasdaq is down the most. Let's see. Q's just took a leg lower to their low of the day. Russell's near the flat line. S&P's just took a leg lower. They're down about 27 right now. Overall, not a heck of a lot going on. If we look at kind of the breakdown of the market, the Dow is near the flat line. We're really just seeing tech getting hit today. Nvidia's down 2+%, traded right down to its 50-day moving average. Bitcoin's under pressure. Just a little bit of profit taking, but this is the time. Well, it's always the time to look for protection. It is always, always the time. But right now, folks, we have got to look to hedge our portfolios. Okay, we always look for that. We always talk about buying when you can and not when you have to. And this is exactly what that means, is buying that portfolio or position protection. Okay, when you go out and you go shop for your auto insurance, homeowners insurance, when do you want to do that? You don't want to do that after something has happened. You don't want to do that after an accident because then your premiums are higher, right? Well, same thing in the market. You want to get that protection when it is cheap. And you know what, folks? It is really cheap right now. It is really cheap right now. In fact, the portfolio protection that you can get in the S&Ps right now, okay, it's the cheapest it's been. It is the cheapest it's been with the exception of 2 times in the last 30 years. Okay, even with a little bit of a dip today, and vol is up a little bit today, not much. It is the cheapest in 30 years. And you always hear me harping on this about buying the protection when you can and not when you have to. Okay, and that doesn't mean that you have to be bearish. It doesn't mean that you might think the market is going down. It's just a part of trading. It is just a part of managing your portfolio, whether it is managing your trades or managing an IRA or a long-term portfolio. Okay, and quite frankly, if you buy that protection, you know what the best thing is? You never use it, right? That's why you want to get it when it's cheap, and you hope it goes out worthless. Okay, how many of you would give up, just a small amount, a basis point or two, to have the peace of mind that you're going to be protected if something happens in the marketplace, whether it's days away, weeks away, months away, whenever it might be. And then, okay, I've got that protection. I paid for it. It was cheap. It goes away worthless. Okay, which means the rest of my portfolio either maintained its value or even increased in value. Okay, VIX on Friday closed at its lowest point in 5 months. I know we're going into the last 3 weeks of the year, the Santa Claus potential rally, where, historically the markets just trend up. Okay. And the Santa Claus rally, just again, to reiterate, I know we've gone through this. Santa Claus rally is really the last 5 trading days of December and the first 2 trading days of January. Typically, when the markets go up, volatility comes down. I think we've already hit a bottom in volatility, guys. I really do. And that's why in our positions, we have an IWM downside, we have triple Qs downside. Okay. And that was all just done just for portfolio protection and to take advantage of this incredibly, incredibly low volatility. Okay. How do we kind of think about a hedge? Okay. There's a few things that we really have to think about. Okay. Effectiveness and cost. Okay. And we'll talk about that in a moment. How much are you willing to pay and for what time frame? Okay. Whether you think something is happening imminently or down the road a little bit, you have to understand about your portfolio. Okay. Because you can't just go hedge your portfolio if your portfolio consists of NVIDIA and Microsoft. You can't just go hedge that with a big S&P or something like that. You really would then hedge it with those particular stocks. So is your portfolio well diversified? And if it is, how tied is it either to, or how closely correlated is it to the S&Ps, to the Qs? Maybe it's correlated more to the Russell. Okay. You want to find all that out. Okay. You want to know the amount of leverage that you can get. You want to know the amount of leverage you can get from your hedging. And it's also imperative, guys, to know where implied volatility is, because that is going to direct you into potentially how much to hedge, where to hedge, and how to hedge. So you've got to understand that. Okay, you've got to understand that. All right, let's go through an example here. Okay, and I did this just a little while ago, so these numbers may be a little off, but you're going to see it on here. Okay, so when I put this together here, the S&Ps were trading 6,057. All of the hedges that I am looking at, okay, are basically 1 month out. I just use regular January expiration for this, so it's 5 weeks or so. Again, you can evaluate your own timetable. Maybe it's a week, maybe it's 6 months. Okay, all of these example hedges here are 1 month out, basically. So what I did here with this SPX hedge that we're looking at on the screen right now, with SPX trading 6,057, and let's see, where is it right this moment? SPX is actually, come on, populate here, 6,060. So not so far off. Okay. So I looked at 2 things for you here. One, an at the money hedge, where obviously you're going to get more bang for your buck. It's going to cost more. And then you have to think to yourself, because there's no standard protocol here, you've got to think to yourself, okay, what am I concerned about? What do I think the market may drop? If you think it may drop, how much do I want that protection? Where do I want that protection? So not only did I do an at the money hedge, I did a 5% out of the money hedge. So that 5% out of the money is right around 57.50 in the S&Ps. Okay, so you've got both of those listed there. The cost of one at the money January 17th SPX put, and that's the 60.55 strike, was $71 when I looked at this. Okay, well, $71 times your 100, $7,100. Okay, So based on a $100,000 portfolio, okay, that's what I'm going to base this on, is a $100,000 portfolio. It's about 7%. Okay, the cost of 5% out of the money put, okay, January 17th, same, is only about $2,200. Cost was $22 per put. That's about 2% of your portfolio. Okay, obviously, the further you go out of the money, the less it's going to cost you, but the less protection you're going to have right away. Okay, so here is another example of SPY, because most of us are going to trade in the smaller size contracts. So I did an SPY equivalent also. So SPY, when I did this, was basically 606. Let's see, I think it's a little bit lower right now. Let's take a look. Yeah, it's 605 and a quarter, but this was at 606. Okay, and the at the money expiring put, so the 606 strike put, expiring same January. Okay, $7.90. Okay, $7.90. If you did one of those, okay, if you did one of those, you're talking about $790. Now remember, SPY is 1/10 approximately the size of the SPX. So if you're equating that to your $100,000 portfolio example that we're talking about, that's the reason I put up here 7,900, because you'd be doing 10 of those. Okay, it's approximately 8% of your portfolio. Okay, everybody understand that? Does everybody understand that? So here is how you would calculate, folks. Here's how you would calculate how many of these potential puts you would need to fully hedge a $100,000 portfolio. Okay, and then you can kind of go from there, how much the portfolio you want to hedge, 10%, 20%, whatever it might be. But before we do that, guys, let's get the word of the day out here. And today it is cheap, because volatility is cheap. Protection is cheap. So let's get that up on the board here for today's wheel. All right, I see him coming in here. Awesome. Leave that up here for another minute or so. Anybody catch football game last night? Chiefs winning on the doinker with time running out. Only the Chiefs could pull that off. I actually felt bad for the Chargers last night. That was a pretty good game, as was the Bills-Rams game. Don't know if you have any of those dogs in the hunt, but it was a heck of a day for fantasy football, that's for sure. Okay, we got a lot of those in here now. So, example, SPY 606. Okay, if you're buying the 606 put, so if you want to buy the at the money put, okay, the at the money put, TJ, yeah, I agree. But you know what? The Rams played great last night. So to fully hedge a $100,000 portfolio, this is how you calculate it. Take your portfolio value. So we've got 100 grand here. Divide that by the index. So in SPY's case, divide it by 606. Divide that by 100. okay, because that's the contract multiplier. And then you'll see that last part there of dividing by 0.5. I'm dividing that by 0.5 because that's the delta. Okay, and if I do that, it comes out to 3.3 contracts. Or you can't get 3.3, you have to do 3 contracts. Now, if you wanted to use an out of the money put, okay, which obviously is going to cost less, that divisor down there, instead of 0.5, it might be 0.4, 0.3, or something less than that. So you're going to have to get more contracts. Okay, here is an actual formula. Okay, if you want to get your full hedge, take your portfolio value and divide that by the share price of the ETF. So if you're using SPY or Qs or IWM, whatever it is, multiplied by the delta, multiplied by 100. Okay, now keep in mind, the VIX is really cheap right now. You know, it's currently around 13. So what is the VIX? The VIX is representative of 30-day looking forward S&P implied volatility. So that 30-day S&P implied volatility is incredibly cheap. If VIX goes up, that means the implied vol is going up and it's going to cost you more. Okay, we always talk about, guys, buy low, sell high. And that is regardless if you're looking at a stock or if you're looking at volatility. Okay, so here, for instance, here is VIX. Okay, here is VIX. Look at where we are right here, guys. Look at where we are right here. I wish my drawing tool would work, but it is not. Okay, so look at this right here, guys. Here's where we are. Can it go a couple shekels lower? Can it go, a little bit cheaper? Could. Probability is, boy, it's going higher from here. Okay, so you have got to pay attention to that. You can see here now is the volatility of the VIX. This is known as VVIX. Okay, and look how cheap this was. Look how cheap this was last week. I mean, this is as cheap as it's been pretty much all year. It has upticked a little bit, the volatility of the VIX. Okay, but not all that much. So you got to keep in mind implied volatility. Why is that important? Well, what if you don't want to spend money? What if you don't want to spend money to hedge your position? You can always sell calls, right? You can sell covered calls for protection. Now, it's not going to give you as much protection because all you can make from that is the amount that you collect from your covered calls as opposed to owning puts. But if you're more comfortable doing that, you certainly can. But in my opinion, now is not the time to be selling covered calls. When is the time? Whether it's in a stock or for a portfolio, whatever it might be, when is the time, guys, to sell covered calls rather than buying puts? And we employ this on our strategies all the time. When would you rather have a credit than a debit? Yeah, when vol is higher. Exactly. When those premium levels are higher, right? Go back to thinking about buying that insurance, right? You want to buy it when it's cheap. You don't want to buy it when it's expensive. We'd almost rather sell it when it's expensive. Okay, so now is not the time where vol is expensive. So if you're looking for a portfolio hedge, my humble opinion, okay, it's by buying the downside. Again, you choose what you want to do in terms of how much you want to hedge your portfolio, how far down you want to hedge it, and for what time frame. But it is very, very important to keep in mind, guys, that you understand what your portfolio is made up of. Okay, if your portfolio is all industrials, you're probably not going to want to hedge that with the Qs, right? So it is really important to look at what that beta might be. Beta is what we call a relationship to how much one thing moves versus the other. What is the beta of Microsoft to the S&Ps? What is the beta of NVIDIA to the Qs, etc.? So when you're looking for that hedge, you really want to get the highest correlation possible. Okay? That is in your best interest. And again, you hope that it never pays off. And I can't tell you guys, and again, I'm not advocating to go out and spend your money and buy something you don't want to. But I cannot tell you what peace of mind, how much that brings to your psychological aspect of trading. If you know you have that backstop in and you've got it cheap, boy, you're gonna just be able to trade with a much clearer head than kind of always looking over your shoulder, always thinking about what if that next event happens. Okay, I can tell you as a trader when I was down on the trading floor. Okay, when I was down on the trading floor, I was always, did I say always, long units. Now, what does units mean? It means I always had my downside protection. Always. It just allowed me to trade better. Just knowing that, okay, when the you-know-what hits the fan or when volatility spikes, I've got the ammo to be able to sell it when it gets really expensive. There are a lot of traders that never wanted to have those long units. Hey, Jeff Lake, are you listening right now? Jeff Lake, Laker. Laker was obviously one of our traders at our trading firm. Okay. TJ, you can definitely buy those inverse, but again, remember, you've got to look at the makeup. Okay. You got to look at the makeup of what's in those reverse ETFs. Okay. Now, if you're doing that, let's say you were going to use Qs as your hedge and you find one of these inverse ETFs that replicates, the exact opposite or close to the exact opposite of what the Qs might be. Sure. You also want to do something though, guys. You also want to do something where there's a lot of liquidity, because probably 9 out of 10 times, maybe 8 out of 10 times, if you put on a portfolio hedge, you're not going to let those options go to expiration. Okay, you might sell them out. You might trade them back and forth. If you buy when volatility is really low and we get a bump up in vol, okay, you may absolutely just sell those out. Okay, we're not necessarily holding those options until expiration. Hey, Paul August, not sure if you just put hedge in there as the word of the day, but that is not the word of the day, sir. We'll give you a second shot at it. Absolutely, Derek. There's nothing ever wrong with that. Selling and buying again later. There's nothing ever wrong with that. Final call for the word of the day, folks. Final call for the word of the day. I'm going to put this up one more time here, guys. This is pretty important. If you're looking for a portfolio hedge, to understand this equation. Okay, write it down, take a screenshot. Okay, this is how you would protect your portfolio. You're better off watching Charlie, Paul. You're better off watching Charlie. Which, by the way, Charlie will be back in the driver's seat tomorrow, everybody, as I'm traveling back to Chicago. Charlie will be back in the driver's seat tomorrow. All right, let's take a quick look at what the market is doing here now. Basically nothing since we started. Qs came off the low of the day. S&Ps came off the low of the day. Really just kind of flatlining here, guys. Anything standing out? You know, the Bitcoin related stocks, they're getting hit today as Bitcoin is down about 2%. Couldn't hold to 100,000 again. Pat, again, that is, you know, I'm not suggesting these hedges are for our portfolios, which we do have a VIX position. Okay, so correct. I mean, there's, you know, there's a lot of ways to hedge your portfolio with a lot of different ETFs, etc. Paul, I just put Hershey up on the screen here. Yeah, there was news this morning that Mondelez in specific was maybe looking to buy them. So here's your Hershey's screen. All right, guys. I think we're closed on the wheel. Mike, are we? Mike Clark, we closed on the wheel here. I'm waiting for it here, guys. You are very welcome. You know what? I just want to see what the order flow is today in Hershey. For those of you that don't know how to find the order flow on Thinkorswim, by the way, I have it up on the screen here. If you go to, you know, whatever stock you want, okay, and then you go to midway down here, today's option statistics. Okay, you can see right here, so far 38,000 calls, basically almost 17,000 puts have traded. So, you know, just over 2 to 1 or so calls versus puts. All right, looks like the wheel has been completed. Here we are, everybody. Okie doke. Are we ready? We've had Mike on before as a guest before. Yes, we have. Mike has been on as a guest before. Would you like to see him more, Robert, and everybody else? Would you like to see Mike in here with some of his charts and strategies and all that good stuff? We can make that happen. We can definitely make that happen. Okay, here we go, folks. The wheel is in motion. Today's winner is it Gene Merritt or is it Mike Duke? It is Gene Merritt. Gene Merritt, are you here? Are you here, Gene? Gotta be in it to win it, folks. Gotta be in it to win it. There you are. Okay. Nicely done, Gene. Nicely done. You know what to do. shoot us an email. prosperswag@prospertrading.com. Give me your address, size swag. We will get that out to you. All right, everybody. Thank you. Thank you, thank you, thank you. And don't forget Charlie Moon in the hot seat tomorrow. Everybody, have a fantastic day. We will see you later.